Asian markets are being pulled by two powerful forces. AI optimism's driving a chip-led rally, while surging oil prices revive inflation fears. Live from Sydney, I'm Paul Allen. This is Insight, where we dive deeper into the stories that matter with crucial context and sharp analysis. Well, the Middle East conflict is widening. Houthi attacks on oil tankers and fresh US strikes on Iran are raising the risk of a broader regional escalation. Despite the rally in Asia, investors are weighing the ballooning cost of AI. Alphabet, Tesla and IBM shares under pressure as markets question whether the massive spending will sustain returns. JPMorgan sees investors rotating beyond crowded AI winners, with China Tech, India and Southeast Asia poised for a catch-up. But will rising oil prices play spoil sport? We're going to speak with Rajiv Batra, the bank's head of Asia and co-head of global EM equity strategy. Also, India's asset management sector is booming as investors rush to tap into the rapidly growing equity markets. Top executives from newly listed SBI Funds are going to join the show to discuss how they plan to seize the opportunity. Let's get to our top story today. Yemen's Houthis say they have attacked two oil tankers in the Red Sea, threatening to open a new front in the Iran war. The UK Maritime Trade Operations Centre says a tanker reported being struck southwest of Al-Shaqaiq on the Saudi Red Sea coast. Saudi Arabia didn't immediately comment on that attack, but energy prices have jumped after this apparent expansion of the conflict to the Red Sea, which has emerged as a vital workaround for crude exports. Meanwhile, Secretary of State Marco Rubio says the US is open to negotiations, but military operations will continue.
We remain open to diplomacy. We remain open to working it out in a negotiated way. But right now, they don't seem to be serious about that. And so we're going to continue to protect shipping. At the same time, we are going to, when the opportunity presents itself, degrade their ability to target global shipping.
All right, for more, let's get to Bloomberg East Asia Government Editor John Herskovits. So, John, what more do we know about the Houthi claims of attacking tankers?
Sure. We have claims from the Houthis that they use missiles and drones to attack two Saudi-flagged oil tankers, causing fires and also claiming about 10 ships to retreat. These claims cannot be verified, but there is evidence of disruption. As you reported earlier, the UK Maritime Trade Operations Centre said the master of one tanker reported being hit just before the Houthis made these claims. Kepler, another tracking service, said about 6 ships had rerouted after the Houthis made their threats. So we haven't heard from Saudi Arabia yet to confirm what has happened. There is evidence of some ships turning around, rerouting, but what the Houthis claim actually happened, we don't have full verification yet of what they have claimed has happened.
So give us a sense of how much of a threat this group poses in terms of opening a new front potentially in the war, this time on the Red Sea.
Yeah, I mean, this group threatened shipping the Red Sea from about 2023 to 25. At the bottom of the Red Sea, there's that choke point, the Bab al-Mandeb, which before the Houthis began their campaign, about 10% of global trade went through that passageway. As of 2025, that number went down to about 3%. So it's a crucial choke point, and the Saudis have been rerouting their oil that was destined for the Strait of Hormuz towards the Red Sea. Yanbu is one of the key ports for this. If they can't use the strait at the bottom, they'll go through the Suez Canal, and this just raises shipping costs because it means a long trip around Africa for oil, a lot of which is headed to Asian markets. So the effects for global for the transport of oil are there. It really could affect shipping going through the Red Sea. And for customers in Asia that rely on oil from the Middle East, it just adds another impediment for supply flows getting to Asian markets in an orderly manner.
All Right, that's Bloomberg East Asia Government Editor John Herskovitz there. Now, along with the rising oil prices, markets are also getting nervous about the cost of the AI build-out. Elon Musk's AI ambitions are getting a reality check as Tesla's profits slide. That's despite strong performance in its automotive business. Alphabet, meanwhile, doubling down on the AI race, lifting its spending outlook as tech giants compete to build the infrastructure behind the technology. Let's get to Bloomberg's executive editor for technology, Tom Giles, for more on this. So, Tom, Alphabet lifting its CapEx plans. What have analysts got to say about this?
This company, we thought they were spending a lot before, and this quarter they came out and said, hold my beer, we're spending even more than we said. These are unprecedented numbers in the hundreds of billions of dollars. They raised it to as much as $205 billion. It really speaks to the urgency of obtaining the chips and the infrastructure, the data centers that are needed to fulfill their AI ambitions. This is a company that is advancing in cloud computing. It's advancing in building models. It's weaving Gemini, its large language model, into search, into coding, into a whole host of services that it wants to make better. And the competitive environment is intensifying across the U.S. because Gemini is competing with Anthropic, it's competing with OpenAI. And as we've seen, we've been talking about a lot here in Asia, now they are having to contend with increasingly sophisticated and competitive models here in China, such as we saw recently with Moonshot, such as we've seen for a while with DeepSeek, and the list goes on and on of other companies that are giving Google a run for its money. So that gives you context for why they're spending so much. And the question on the minds of investors is, when will that pay off? When will all that investment result in real changes, real growth to revenue and profit for Google? And will it happen in a timely manner? It's really hard to get our heads around these large numbers, 200 billion plus, for the entire year, because it's just uncharted territory. We've never seen them spend this much, and so investors are antsy.
Let's talk about Tesla as well, also burning cash, profits slipping, switching to a focus really, which has been well telegraphed, spending on robotics and AI. But look, judging by the market reaction, is it safe to say investors prefer Tesla when it's making cars?
It's hard to say how much this is a verdict on their robotic ambitions. In some instances, people are saying that on one hand, you have Google getting punished for spending too much or potentially spending too much on CapEx. The question for Tesla is it spending enough? Are they spending at a rate that will satisfy I think their target for 2026 is 26 billion. And the question on everyone's mind is, are they spending at a pace fast enough to reach that by the end of the year? And are they being ambitious enough?
Well, outside of the earnings story, we're getting some more details now about how those OpenAI models managed to breach AI startup Hugging Face's internal systems. Hugging Face used a Chinese model in the end to carry out forensic analysis of the whole incident after its request to use proprietary AI models got blocked by safety guardrails. So what does this tell us, about any number of things, including the reliability of Chinese AI models?
Yeah, I mean, it tells us a few things. Yes, to your question, when you've got to turn to Chinese models to help you figure out what's going wrong or what's going right or what's too effective about OpenAI, yeah, that speaks to the effectiveness of the models. To my point earlier, they're getting a lot better. And they're showing that when we have conversations about the best models, the top models around the world, you can't just confine that conversation to two players, Anthropic, OpenAI. You have to broaden that conversation. We have to learn a new language. We have to think more expansively to say and admit that China's models are pretty darn good. And yeah, we're going to turn to them when we need to do forensics on what happened with OpenAI. Again, to its credit, OpenAI, this breach of Hugging Face, it was unprecedented. It was not planned. It was not what they asked it to do. but it does speak to how incredibly powerful this is. And it suggests to me and other people that, OpenAI might have to even tighten the guardrails that it puts around even the way it tests. Because remember, this happened in a testing environment. It was supposed to be operating what they call a sandbox. The tool expanded beyond that sandbox, and it got into the open web, and that's where it hacked into Hugging Face.
Yeah, it was a somewhat chilling morning. Bloomberg's executive editor for technology, Tom Giles, thank you. Let's take a look at our markets tracking around the Asia Pacific this Thursday. We've got Korea having a relatively normal day by its standards. It's still up 2.5%, though. We did have South Korean GDP coming in as a beat a bit earlier, 3.7%. We've got SK Hynix earnings coming up next week, by the way, so that should be somewhat interesting as well. Now, elsewhere, what have we got? Indonesia, definitely a worthy mention here, up 1.2%. And now we've got Indonesian stocks on the cusp of a bull market, up 20% since that June low. So what a difference a few weeks has made for that market. Now, our next guest has an overweight call on South Korean stocks and expects emerging market earnings in the second quarter to be strong as well, with a notable concentration into the Korean tech and memory space. Let's get to Rajiv Batra, now head of Asia and co-head of Global Emerging Markets Equity Strategy at JPMorgan. Rajiv, thanks so much for your time today. I just want to get your sense of what a good allocation is for Korea at the moment, considering it's very, very volatile and is actually the worst performing index in Asia this month.
Thanks, Paul, for having me back on the show. So Korea has gone through a volatile phase over the last few weeks, but that was more due to the technical issues, as we can see, the leverage in the markets overall, or you can say the crowded positions that has got built up. But a recent drawdown which we have seen 75% of the rollover has already happened in the leverage ETF. Similarly, the microstructures which was troubling the market, that is getting resolved overall. And interestingly, hyperscalers have started reporting the result, and we have seen that the capex guidance, what market was looking for, that has started coming. It's not fully done yet, because till 16th of August you will get the full color when most of your CSPs and hyperscalers will report. But taking all this into account, we continue to remain bullish on the tech sector, which remain the dominant and the key theme in Korea as well as in emerging market. And beyond that, we still prefer industrials, defense, as well as banks, who are the beneficiaries of the wealth effect theme in Korea.
Yeah, well, it has been a stellar year for the Kospi, the volatility notwithstanding, up 66% year to date, although to my point, we're down 20% since the June peak. So when you see those sorts of pullbacks, it sounds like you look at those as a buying opportunity rather than the heat coming out of this market.
No, definitely, if fundamentals stays intact, and the fundamentals means your earnings, where market is forecasting in this particular quarter up north of 400% kind of a growth in Korea, MSCI Korea equities, and close to around 40-45% earning growth in 2027. If all these numbers are getting meet or even beat per se, this market will keep on continuing to rally, and that's where our price target of 12,500 come on Kospi 12 months down the line, which we are forecasting, is largely being premised on earnings growth rather than purely on re-rating only. The risk premium may continue to remain because of markets operating on a very concentrated AI bet, and hence this is the reason why the questions will keep on coming regarding the monetizations on the AI trade, whether how long the demand supply imbalance remain on the tech hardware on the chip industry side, and then finally when we are going to see the cash flows and the revenue returns for my hyperscalers and CSPs. So taking all these factors into account and the volatility which Kospi or VKospi have seen overall, it's fair to say the market will be driven by the fundamentals and earning growth rather than looking for any kind of a valuation re-rating.
Okay, well, we've seen the Kospi come off that 20% since the June peak. Compare that to Indonesia, up 20% since its June trough. So in bull market territory now for Indonesia's index. What's driving this? What's brought about that turnaround?
So you can see that the technical rotations have started in the market since early June on the back of the initial announcement of US-Iran peace deal that led to, you can say, rollover of oil prices. Entire second quarter, we saw oil prices only keep on getting lower. Beyond that, concerns regarding inflation is getting heated up, which will lead to a massive tightening cycle across South Asia region or in the other EM countries. Even that headwind started receding, and that has now led to a rally in the pockets beyond non-AI, which includes India, which includes ASEAN, which includes even some domestic part of China too. The sustainability of this rotation or the technical bull market, which Indonesia is now adding up, is dependent on whether the oil prices can again start declining, and that's very tough call to make right now in a current situation where geopolitical uncertainty has started rising again. Beyond that, we also need to worry that the US rates are getting higher, and if you look at the pricing from the bond markets are pricing in a hike in September itself from the Fed. And then the last trouble for the EM, DXY index is now well above 100 mark. We have seen 2% appreciation in dollar last month, and even month to date dollar is plateauing at a higher level, which is not a good news for the non-AI market, which include a lot of current account deficit markets as well as oil importers.
Yeah, well, we've still got stocks in Indonesia rising today. The index up 1.25% at the moment. That is even against a backdrop of rising oil prices. We've got Brent now at 96.28. So can you help us square that circle in terms of, you mentioned sustainability. Could we see a reversal sooner rather than later?
So, Paul, it's totally dependent on how higher oil can grow and how higher, at a higher level, it can sustain overall. Right now, the equity markets is rising more in the non-AI world due to the re-rating factors rather than the positive earnings revision. Why re-rating coming into the picture? Because post, you can say, the rise in temperature on the war side in the March, as oil started sliding lower over there, most of the investors got caught on the wrong foot because they were massively underweight on the non-AI space. Now when there's some of the headwind got reduced, people are not fully believing the story that oil is inching towards a 3-digit mark or can sustain that level for a longer duration. If that drivers plays out, oil being 3-digit, maintaining that level for longer, that's where again the downward earnings revision cycle will start for non-AI. Right now, the entire rally which you are seeing for the past 1.5 months, be it in ASEAN 11% or Indonesia from the trough around 20%, has came on the back of the easing headwind. But looking at the three scenario, oil, dollar and rates, these headwinds are again back on the table, and it will hurt us through the downward earnings revision.
Just in terms of Indonesia, I mean, MSCI has been expressing some concerns here around governance, transparency, free float requirements as well. None of these things have really gone away. Do you think investor fears around this market are over in anticipation of reforms coming?
Look, most of the concerns regarding the index inclusion or what MSCI was looking for, the policymakers are rightly trying to address it, and we have seen reforms measures being announced by the policymakers to make sure that there is enough liquidity and they can maintain the EM status overall in the MSCI indices. Right now, market is not fully pricing in that yet. If we look at the long-only investor positioning, the underweight on Indonesia from investors, foreign investors, are quite huge over there as such. They are not under-owning it, but I will say the positioning are not at a peak level what Indonesia enjoyed, you can say, till the end of the last year or the past 5 to 10 years. If investors start pricing in that Indonesia will remain in the benchmark and MSCI is now fully happy with what the policymaker measures have done, I think the inflows will start coming back to Indonesia, and the rally which you have asked me in the earlier question will become much more sustainable for Indonesian equities.
Well, Rajiv, it's a good day to have you on because just a few hours ago, JPMorgan did put out a note upgrading Thai stocks, downgrading Philippines. Can you talk us through that call?
So as I've highlighted earlier, right now there is a lot of external headwinds the region is facing, and Southeast Asia is an export and a trade-oriented region. So whenever there are external headwinds, the first one to come under trouble is the ASEAN region over here. So we are watching the escalation, which means higher oil prices, not a good news for most my oil importers in the region. Second, because of the higher rates and the stronger dollar, the sensitivities of ASEAN equities is quite high. And then lastly, the fear of super El Nino has not gone away over there as such. So that is making us a bit conservative on the ASEAN equities post the sharp rebound of 11% which we have seen. In that, we are revisiting our allocation, and we are looking at the pockets that can still have a sustainable earning growth or the positive earnings revision trend over the next 12 months. And that's where Thailand fits the bill because of exposure to the AI stocks or the AI universe, which will be the beneficiaries of the higher growth in the system, followed by a weaker Thai baht that supports the tourism trade or the exporters' revenue overall. And beyond that, the political stability, which is giving, you can say, some tailwinds to the capex growth in the economy and some rebound for the consumption. On contrary, for Philippines, there are limited catalysts that can lead to a re-rating overall, and beyond higher oil prices, the concerns of stronger El Nino, because remember, Philippines is a huge importer of not just energy, even food items also. So that will be a concern. And beyond that, if we are heading towards higher rates and stronger dollar, Philippines equities or Philippines corporates earnings are quite sensitive to it. So this is the reason why we downgraded Philippines equities to underweight and upgraded Thai equities to neutral.
Rajiv, just quickly before we let you go, I want to get your thoughts on India, because that's another market that sits at the intersection of these themes. You know, very vulnerable to those rising oil prices, but a number of our guests talk about it in terms of being a hedge against the AI rally. So what's a sensible allocation for India at the moment?
So India has emerged as a hedge on the AI trade. When we look at the outperformance in the last month and even the month to date, you can say a flattish but a good relative outperformance to Asia. The big driver now for India to move higher is consensus expectation from India is not very high. The earning growth forecast for consensus for FY27 has dropped to 10 to 11%, which is a current number. And beyond that, if we look at valuation, premium has declined to the EM overall. Okay. And that is now leading towards India Rajiv. Trade making a comeback.
Great, Rajiv. We're out of time, unfortunately, but thanks as always for your insights. That's Rajiv Batra, Head of Asia and Co-Head of Global EM Equity Strategy at JPMorgan. We have plenty more ahead. This is Bloomberg. Welcome back. You're watching Insight. Let's take a look at the oil price. Just keeps on grinding higher, 96.36 a barrel now for Brent. President Trump pledging to strike bridges and power plants, including around Tehran. Iran, meanwhile, saying if it can't sell oil, no one can. Houthis also attacking tankers at the entrance to the Red Sea, so that's putting upward pressure on the oil price. Implications for equities, well, it's a bit of a mixed picture at the moment. Pretty good day in Hong Kong. The Hang Seng better by 1.25%. The Kospi better by 2.6%, and that's despite some rather mixed reaction to some of those tech earnings that we saw from the US. The broader MSCI Asia Pacific, though, in positive territory. Still to come, SBI Funds Management's billion-dollar market debut this week followed the largest IPO in India so far in 2026. The company's CEO and executive president both joining us exclusively next to discuss the firm's plans. This is Bloomberg. Well, Welcome back. You're watching Insights. Let's take a quick look at where markets stand. We have mainland Chinese markets heading off to lunch. Japan markets, meanwhile, coming back online. We had the Nikkei better by about 0.5%. The CSI 300, meanwhile, softer by about 0.25%. Once again, though, it is the Kospi that is the star of the show. 3% gains today. We've got a rare day without the sidecar being activated. That's the first time this week. But chipmakers having a good day. Earlier, we had Tesla profit missing. Alphabet falling after boosting its capex forecast way up to more than $200 billion. So that means, well, more chips going to be needed. So Korean chip makers performing strongly. The crude price also performing strongly as the situation continues to escalate, not just around the Strait of Hormuz, but also around the Red Sea, with Houthi rebels saying they've attacked tankers at the aptly known Gate of Tears. Let's take a look at Indian futures as well. Got a number of companies reporting today, among them Infosys, Interglobe Aviation. The pharmaceutical company Cipla also going to be reporting today. This is off the back of those tariffs on pharmaceuticals announced by the US yesterday. But take a look at the rupee. Yeah, hovering around record lows again. So traders on watch for some potential intervention here, really feeling the pressure from those rising oil prices. Also concerns around inflation, external risks as well. We've got yields ticking up in India also. The 10-year up 6.8 at the moment. Now, one of the standout India market stories this week has, of course, been the strong debut of SBI Funds, signalling healthy investor appetite for large offerings. Joining us exclusively now, we've got a double header. SBI Funds Management MD and CEO Debasish Mishra, alongside Executive President RS Srinivas Jain. Gentlemen, thank you so much for your time today. Debasish, I would like to start with you if I can. After this successful IPO, can you talk to us a little bit about what your key priorities are now over the next few years or so? You're going to expand the product suite, a bigger distribution network, new products. What do you have in mind?
Thank you. Thank you all the investors in the globe and India for supporting our IPO in the large scale. So priorities for the next 3 to 5 years will be 4 categories or 4 ways. One, first priority is democratizing the investments and the investment climate in the whole country. In India, we have 1.4 billion people, but hardly 10% are yet into investment platforms in mutual funds. So our aim will be to bring others from the cities, from the towns, from the tier 2, tier 3 cities to our fold to make investment as quick, as easy as possible for these citizens. Second, as we cover a large number of investors, we'll also focus on digital delivery. So digital way of serving, investing, giving them advices, bot, AI-based solutions. These will be our priorities for the coming years. And third is giving value to investor. As you know, that investment is subject to value creation. So our aim will be to add value for all the investors, all my shareholders in the coming years. And finally, we're also going to the new areas like PMS, AIF, alternates, international. We have already a subsidiary in the GIFT City, that is our SBI Funds International Limited. Through this, we'll try to expand our base in international business. Thank you.
Srinivas, I'd like to ask you as well. I mean, this listing makes you the number 2 listed asset manager now in India, behind the market leader ICICI Prudential, your competitor. Do you feel what Debasish has outlined there is going to be enough to make you the number 1 fund manager? What else needs to be done?
Thank you for having us, Paul. It's a good question, but end of the day, it's more than the market cap. We are already a market leader. We are about 15.6% market share, makes us the largest asset manager in the country today. Listing is a process of unlocking this value, and we think the value will unfold in coming days. And we are not here to where would the market cap be for SBI Funds Management. Eventually, the market will rate us for the business that we have created. We've built a fantastic franchisee. Not just we have more in terms of ability to raise assets. We've already proven that. We are a very large institutional player in India today, managing very large pools of money for portfolio management services, large investors. And of course, we have massive plans like Mr. Debasish talked about in terms of growing the business. So I think the market will, value us accordingly. And we feel that as a market leader in asset management, we should be fairly valued in coming days.
And Srinivas, we've also seen retail participation in these mutual funds rising very sharply in recent years. Can you talk to us about some of the trends that you're noticing in domestic investor behavior?
Yeah, thank you, Paul. That's, I think, what Mr. Debashish kind of talked about. The retail revolution is just about to begin. It all started with the digitization of the India stack and availability of that. Post-COVID, this has now picked up massive steam. The participation by the young investors in India is now going through the roof. The industry actually ran a very large campaign called Mutual Fund Sahi. It's basically meant that the mutual fund is good for you, and that campaign has attracted a lot of young investors. And we at SBI Funds Management have been actually expanding the market by what we call as beyond the top 30 market, where SBI, our own parent distribution company, has a massive footprint, 25,000 plus branches. SBI itself has about 550 million customer base. It's a massive base of investors. So we are now tapping that in a big way. As new generation investors comes on board, their expectation to go beyond the regular contractual savings of fixed deposits and other interest yielding securities to a more market linked capability is growing, and I think we are benefiting from that. And in incoming days, I think we will unlock that in a much more faster way.
Debashish, I want to get back to you to discuss the expiration of the lockup period. I mean, this debut, you're only a couple of days old, listed on the market. So once that lockup period expires, do you anticipate Amundi to consider any more stake dilution?
See, we are now, this is the first step of divestment and this OFS. So both parents, SBI and Amundi, divested 10% stake. We have plans as per the regulators' guidelines. We can go up to 25% in coming 10 years. These plans are in place, but when it will come, we'll decide, our board will decide in due course of time. Now, I'll also respond to the question you asked to Srinivas. See, the way democratization of investment happening in the country, it is very fast. And with a large number of population coming to the investment field, we have the biggest moat of the distribution network to our parent bank, as well as our own mutual fund distributors to move across the country and make this possible in the coming years. Thank you.
So, Debashish, you talk about your wide moat. You've also got some of the lowest operating expenses among Indian asset managers. How are you going to maintain that? And is the current approach sustainable, or is that something you'll be taking a look at?
Yeah, good question, Paul. See, the commoditization happened in mutual fund products. The products are now streamlined with the regulator coming on this area. More or less, the products are in similar way of delivery to the customer. So what differentiates is the scale. The scale of operation will make a difference. And that is what we are meaning about democratization, about moving to the villages, towns, cities, and the metro centers. So scale will make a difference for sustainable income as well as market share.
Srinivas, I'd like to go back to you now, if I can. One of the features of the Indian market has been foreign inflows. They've tapered off a little since the surge we saw at the start of the year. What's your outlook for foreign inflows to India over the next 12 to 18 months, say? And what factors do you feel are really shaping global investor sentiment towards India?
Well, I can give you from my anecdotal evidence that we were around the world talking to largest long-term investors, including hedge fund, and our interaction with them have been very, very positive. In fact, if you see our IPO, which just closed last week, we had a massive participation from global investors, the marquee sovereign wealth funds, the large long-only funds, and of course, hedge funds have invested significantly. That also tells you that for a good franchise like us, there's a massive appetite. And India actually has such great franchises in the country. And we think in coming days, as the risk-on-risk-off is off, in coming days, this appetite should go up. But one thing, Paul, is that, the Indian appetite itself is so large. And I wanted to give you one data point. Internally, SBI Mutual Fund, we have this systematic investment plans. And they actually contribute a very big chunk of new money that we get. And this is a spread over close to about 15 million customers who invest every month with us on this plan. So they themselves contribute close to about 4,000 crores worth of new business every month. So we already have a large pipeline for us already played out. And of course, thank you, like I said, the global investors are also now turning very positive in India.
Srinivas, I'd like to ask you also, to what degree do you feel a weak rupee has been supporting foreign inflows as well? And it's a good day to be talking about this because it's getting near record lows again. Do you have a forecast for the currency also?
I don't think we have any dedicated forecast, but we believe that the rupee is going to be in a narrow band for the time being as the geopolitical things plays out globally. And obviously, as an asset manager, we don't take a currency bet directly. We're all a rupee player. Everything that we have is basically an India rupee capability. We do have some US investments that we do for Indian investors who are mutual fund route. Having said that, I think rupee is a great entry point for multiple global investors. I think it gives a good opportunity for people to enter. And this is, as an emerging market, entity in India, there is always this little bit of, depreciation that investors have already been factoring as they start looking at investing. But maybe at current levels of 96, 97 levels are a very good level for people to invest.
Yes, and we're just hearing that the RBI has just been selling dollars in the foreign market to support the rupee. So we're just keeping an eye on the currency at the moment. But Debashish, I want to go back to you now. Can you talk to us about how investors see the earnings outlook for Indian companies? And, what's your forecast there for the next year?
So the companies in India have been doing well, and there has been a wide participation of private sector investment. As we see now, the credit offtake has been roughly 15 to 17% in the first quarter. So that way, the investment climate will be also very good for the coming 3 quarters, because this keeps a pace of investing in the market so that the private sector investment goes up. Secondly, there has been a large infrastructure projects which are already ongoing in the country. We have the airports coming up. We have also large and those are being funded by both private and public. So we see that the industry is involved in this sector. And the future industrial growth will be good in the country.
Right, we've only got a couple of minutes left, or even a minute or so. Srinivas, I'd like to just finish with you, and can you tell us about what you feel the biggest risks, the biggest opportunities are for SBI Funds and the Indian market more generally going forward?
I think the risk is largely contained at this stage when the market has so much of value left. I think the potential upside for the market is very high, and I think the market volatility is kind of behind us. And so that risk is always there for an asset manager player like us, mark-to-market risk, which impacts our asset under management. But I think the potential opportunity is immense, and I think Mr. Mishra talked about it. I think the first biggest opportunity that we see is low penetration. And with digitization, and now we have this new KYC norms, which helps us for uniform KYC across the board. Our ability to convert that opportunity is also going up in a big way. So I think in coming days, you'll see opportunity outplaying the kind of threats that are there in the market for us.
All right, Debashish Mishra, MD and CEO of SBI Funds Management, and RS Srinivas Jain, Executive President of SBI Funds Management. Thank you so much for joining us today. Still to come, the US and India pressing ahead with trade talks, even as President Trump threatens new tariffs on generic drugs. We'll take a look at what's at stake for one of India's most important export sectors and whether a deal is still within reach. This is Bloomberg. Welcome back. You're watching Insight. Let's take a look at the market open in India. We did have a little bit of selling in the pre-market. We've got the Sensex off about 0.5% at the moment. The Nifty IT index off by about the same. Indian rupee at the bottom of your screen there, hitting historic lows. We did hear a short time ago that the RBI had been selling dollars to prop up the currency, not having much of an impact at the moment though. A couple of stocks we're watching. Dr. Reddy's, the pharmaceutical company, off nearly 2% in the early going. going. Cipla, another pharmaceutical company, down 1.2%, and they'll be announcing earnings a little bit later on today. Now, we've also heard from Prime Minister Narendra Modi making his first remarks on the protests that have been gripping Delhi from students. He says that he's asked authorities and officials to take needed steps to fast-track courts to ensure swift punishment for those involved. So that is Prime Minister Narendra Modi making some comments in a post on X. Staying on India, it is pushing to reach a final trade agreement with the United States even after Washington issued new tariff threats on pharmaceutical products. Top diplomats from both countries have met on the sidelines of the ASEAN meeting in Manila, and Bloomberg's Min Min Lo's at the event. She joins us now with more. So, Min Min, what came out of those meetings between Rubio and Foreign Minister Jaishankar?
Yeah, so it looks like the two sides were discussing that interim trade deal, which has been under negotiation for more than a year. And Marco Rubio said that it could potentially be concluded in 2 to 3 months, or in 3 to 4 months' time. And he said that most details have been ironed out except for one key stumbling block, which is the Section 301 investigation into overcapacity that could lead to 12.5% tariffs on Indian goods. But bear in mind, just yesterday, the US has just announced additional 100% tariffs on generic drugs being exported to the US. That would kick in 2 years' time unless these drug manufacturers move production to the US. Marco Rubio was expecting the Indian foreign minister to raise this, but apparently he said it wasn't discussed at the meeting yesterday. And at this point, it's not clear whether India would secure any exemptions given they will be disproportionately affected. They are by far the largest supplier of those generic drugs to the US. And of course, one of the key strategies for India to deal with those tariffs is to diversify its trade. So that's why he also met with the ASEAN foreign ministers and said he will engage with ASEAN to expand the supply chain and to boost economic resilience.
Well, Marco Rubio also had a high-profile meeting with China's Wang Yi. What was the readout from that?
Yeah, so the two men met for about more than an hour yesterday evening, and the Chinese readout said that it was positive and constructive. No surprise that the main message from China was for the US to adhere to that one China principle. And one of the key outcomes is that Marco Rubio said that the two sides will implement the Board of Trade sometime before September, before President Xi's planned trip to Washington. Now, this was first announced in May during the presidential summit in Beijing, and it could potentially reduce tariffs on at least $30 billion worth of goods in non-sensitive sectors. Now, it's not clear whether the two sides discuss tech at all. It did not feature in the Chinese Foreign Ministry statement. But of course, this has been the key sticking point between the two sides, especially after the launch of Kimi K3. The US is now accusing Moonshot AI of illegally accessing these NVIDIA chips and servers in third countries like Thailand. So this is potentially something that could derail any potential good feelings between the two sides.
Now, you also got to speak with Canada's foreign minister yesterday. What were the key takeaways?
Yes, I spoke to her yesterday and I actually asked her reaction to the additional 50% tariffs that the US is imposing on Canada and whether or not Canada would consider some concessions to the US in exchange for lower tariffs. She sidestepped that question and simply said that Canada is looking to diversify its trade again, a strategy to shield the impact against those US tariffs. Have a listen.
We are doubling non-U.S. trade over the next 10 years, but we also want to make sure that we have a very stable and distinct sovereign approach to our economic future, and that means diversifying trade.
I suppose this is partly to shield from the impact of U.S. tariffs as well. And speaking of that, there is an additional 50% tariffs from the U.S. hitting Canadian goods in 30 days' time. During this 30-day period, is Canada willing to look at offering concessions to the U.S. in exchange for lower tariffs?
So let's just remember that Canada and the United States have been close trading partners for decades and decades. We are bound together by geography. The Prime Minister spoke with the President yesterday, and they agreed to intensify talks relating to trade, and that will be undertaken by our Minister for Canada-US Trade and our Chief Trade Negotiator. At the same time, we have to remember we can do multiple things at the same time, and therefore pursuing this diversified trade agenda, making sure that we have these free trade agreements with other countries, such as the Philippines. We're negotiating a comprehensive economic partnership agreement with India right now. We signed a free trade agreement with Indonesia in late 2025. Those are just examples of the way we'll diversify while those trade talks with the United States are ongoing. Right now, we are the only G7 country that has a free trade agreement with every other G7 country. That's the foundation of our trade diversification policy. But we are going a step further with those over 20 agreements in security, defense, and economic matters, with free trade negotiations that are occurring now.
One of the big concerns here is the inflation that is brought about by the Iran war. And I wonder, as an energy exporter, as Canada is an energy exporter, is your energy sales to Asia increasing after the Iran war?
It's a good point to highlight Canada's competitive advantage in the area of energy. Whether it's LNG from our west coast, whether it is clean or conventional, whether it is nuclear or solar or wind power, Canada is a leader. We will be the only G7 country working on the SMR technology, for example, out of Darlington, Ontario. All of that to say that energy figures quite prominently in both our bilateral and our multilateral conversations. And around the table this morning, I heard significant interest from ASEAN countries about ensuring that there's energy cooperation and climate change.
There you go, diversifying trade and increasing non-US exports, in fact doubling that over the next decade. That is a key strategy for Canada, and that's why Canada is also in the process of negotiating this free trade agreement with ASEAN countries. According to Minister Anand, that is going to be concluded by the end of this year. And I also got to ask her about her relationship with China as well. She got to meet with Foreign Minister Wang, and it seems like it's quite a nuanced relations there. We did see a bit of a warming up of relations as Canada lifted some of those tariffs, the 100% tariffs on Chinese EVs, but still, when it comes to Chinese investments, that still seems to be quite a sensitive topic.
All right, Bloomberg's China correspondent Min Min Lo there in Manila. Now, before we go, Bloomberg is live in Cambodia tomorrow for exclusive interviews with Prime Minister Hun Manet and his top ministers. We'll be discussing the border conflict with Thailand, energy security initiatives, and of course relations with China. That is from 7 a.m. Hong Kong time Friday. That's 7 p.m. Thursday in New York. And in about half an hour's time, Bloomberg reporters will be online to answer your questions about India's student protests, the government's response, and what it means for India's political outlook. That is available for terminal subscribers and on Bloomberg.com/live Q&A. And that is it for Insight. Horizons Middle East and Africa is up next. This is Bloomberg.